Hello and welcome to our continuing coverage of Budget 2019, interim or otherwise. Well, until the last few days before the budget, the opposition went all out about an income support scheme for the farmers if they were voted back to power. Market participants thought that the current government was on the back foot to announce an equal or a bigger measure in this interim budget. Come the day of the budget, and the government has announced an income support scheme for the farmers, announced tax relief for the salaried class, as well as a pension scheme for the elderly. So has the Prime Minister hit the ball out of the park, or have these promises been made on a slightly sticky wicket? I'm referring to the cricket terminology because I have with me a cricket enthusiast as well, Nilesh Shah of Kotak AMC. Nilesh, thanks so much for joining in. Firstly, do the scores add up? When I hear that whole long interim budget speech, it was pretty long from an interim budget perspective, standards as well. A lot of revenue items announced, expenses announced. I don't know if the normal market forces or the normal growth forces compensate for that kind of income coming in FY20.
So one, it's a play on growth. If the growth picks up, then automatically revenue picks up. We have seen that, risk being taken when government cut almost 300 items from 28% GST bracket to down. So this is again a calculated, calibrated call on reviving growth, which will compensate in terms of higher revenue. Clearly, the government will have to keep Plan B open, and that is your monetization of assets. Government has estimated about 80,000 crore from divestment, but clearly the potential is far more. You can do strategic divestment of your assets, and the experience there is far more remunerative and rewarding. Second, you can also do monetization of your monetization of assets like Custodian of Enemy Property Act, Campa funds, and so on and so forth. Third, you can also monetize your road projects and power plants and so on and so other stuff through InvIT or REIT kind of model, which again gives you spending power. So my guess is that if government becomes innovative on the monetization of assets, then all these estimates can be met on the revenue side, even if there is a shortfall.
The divestment revenues have been pegged at about 90,000 crores. Now, you could argue whether it's steep or otherwise. Let's go with an assumption that the government does manage to do that. A lot of other factors that have come in. I think the GST growth estimates or the direct tax collections also seem reasonable.
Yeah.
But the enhanced number on the RBI dividend part, for example, or the small savings numbers, 1.3 lakh crores if I'm not wrong. Are you happy with those numbers? Do you think these are more or less achievable? I mean, the RBI factor notwithstanding, yeah.
If you look at the 1,30,000 crore small savings borrowing program next year, on 1,25,000 this year, it looks reasonable. Similarly, there is a drawdown of cash balance of 51,000 crore next year. At 41,000 crore this year, again, it looks reasonable. The big gap which could come on the borrowing program side is the open market operations. This year, reserves were dipping. RBI was intervening to support rupee by selling dollars, took the rupee out, and hence it could do open market operations. And open market operations are more than 2,85,000 crore. Next year, the reserves could accrue. Now, it will release liquidity, but certainly it will hamper RBI's ability to do open market operation. So we can't compare next year's borrowing program with this year's borrowing program because of this open market operation differential.
Okay, so in light of all of that, how do the two mother markets shape up? Today, there was an initial hurrah and then a bit of a cool off as well. I wouldn't be surprised on Monday if there could be some more downsides too. But both the bond markets, which had a slightly painful day today compared to the equity markets, and then the equity markets too. The near-term budget, RBI policy, and the global perspective, how do they stack up?
So for the debt market point of view, budget is passé. The focus will be on RBI. Today, repo rate is 6.5, 10-year yield. If I just take a simple average between old 10-year and new 10-year, it is 7.5. Now that's almost 100 basis point. In the good old days, we have seen that spread compressing. So if RBI can communicate with the market, and if RBI is comfortable with the fiscal math, then there is possibility that with or without policy rate cut, we could actually see interest rates coming down. Look at from a longer term perspective, if RBI is comfortable of managing inflation at about 4%, then 10-year yield at 7.5% is 350 basis points. There are very few countries in the world where nominal interest rates will be 3.5%. So there is a long-term case for interest rates to come down. There is a short-term case for interest rates to come down. Put those two things together, we could see interest rates decline despite budget challenges. On the equity market side...
By the way, sorry, just before I come to that, so with the headline numbers, do you believe that there could be a cut? I mean, today the participants on the panel, the opinion was divided right down the middle. Somebody said expect 50, somebody said no, I won't go with anything.
So my guess is that cards are open for RBI. If they look at from an inflation point of view, there is a case for a rate cut because current inflation number is below 3%, well below RBI's forecasted range. If you look at from a real interest rate point of view, there is a case for rate cut. The government can't be paying 3.5% additional real interest rate. If you look at from a RBI's policy communication point of view, a policy before that they were on a tightening mode. They have come back to around neutral in the last policy. Can they switch over to straight easing immediately? Well, they have to take that call. So I will say that it's up to RBI to take a call. But more importantly, without policy rate cut, also you can lower this 100 basis point spread over repo rate. If not a real rate cut, a potential rate cut direction could also result into some sort of compression in this spread, and that should be good enough for debt market.
Okay, the equity market. Sorry, I cut you there.
Yeah. On the equity market side, again, budget is gone. They may discuss on Monday, Tuesday the finer prints, but the real issue will be, one, how the economy actually shapes up. The December quarterly season is now coming to an end, but clearly the Jan, March is the busy season quarter for us. About 30-35% of corporate profit gets generated in this quarter, and clearly the management communication about how they see the momentum building up is important. The Jan GST collection, as announced, has crossed 100,000 crore, and that's a significant achievement considering the tax cuts given. Now, if you can maintain this momentum in Feb as well as March, and mind you, in Feb there are only 28 days, not 31 days.
True.
There will be better support for the equity market. But at the end of the day, sooner than later, market will start discounting elections, and clearly, in the run-up to elections, markets will be worried about what kind of political shape happens, what kind of economic policies followed by the new government. That will be very critical.
So volatility, the name of the game.
Absolutely.
Okay, just one question. One theory that came about today about why the banks didn't do as well, because they were the stronger lot, but they just came off completely, was that, I mean, and whether or not there is some merit here, is that if indeed the revenue numbers on the budget side are not adding up, then the government will have to give up on capex, government-induced capex for better part of FY20. The market was fervently hoping for that to happen, and therefore corporate-facing banks and others able to expand their loan book significantly, and that may now be under question mark. Is that a legitimate fear?
Again, see, if the growth revives, collections will be there, there will be spending on capital side. If growth doesn't revive, you have a plan B, monetize your assets and fund capital spending. So markets will actually watch how government takes these steps. Indian government is hugely asset rich. They are just liquidity poor. We need, that political will to do divestment. And we must not fund revenue expenditure through borrowing. We must fund capital expenditure through borrowing.
Yeah, which has also been the slightly sore point the last couple of years, at least, the quality of the revenue versus capital expenditure as well. My final question to you, Nilesh, and that would be, I agree that in a lot of ways until May or June, till the clarity emerges, the markets will be volatile. The global backdrop, in light of two opposing factors, one, the slowdown that we are seeing, but two, what was earlier believed would be a rate hike cycle and a balance sheet contraction cycle by the Fed, may not necessarily turn out that way if the day before statement is to be believed. How does that picture impact our markets?
So one, clearly if global growth is slowing down marginally, it is very positive for us because our growth rate of 7.5-8% will look far, far superior. It's like the old green advertisement, "Meri kameez aapki kameez se safed hai." The second issue for us is flows. In the month of Jan, emerging markets peers have done far better than us. And clearly that was reflected into poor flows in the whole month of Jan. But come 31st of Jan, suddenly FIS pumped in more money than what they had pumped in an entire month of Jan. So again, it is all about communication with the investors. And if we can manage their expectations, then hopefully the flows will continue. The other worry which we have to focus on is our weightages in MSCI Emerging Market Index. I can convince active investors to invest in India irrespective of benchmark, but I can't convince passive investors to invest irrespective of my fundamentals. They will blindly go by what is the weightage in the index. And as China weight will start increasing over the next 3 years, there will be impact on our weights and that will have impact on our allocation. So we must manage MSCI index transition. It should remain MSCI Emerging Market Index and not MSCI China and other market index.
Yeah, certainly hope so. Okay, Nilesh, pleasure chatting with you as always. Thank you so much for taking the time out and giving us your perspective. Really appreciate it.
Thank you.
Viewers, thanks for tuning in to this very special broadcast.